The AI era is rapidly opening up. In the past, AI was focused on specific areas, such as big data and machine learning, all working behind the scene. But now, large language models like ChatGPT are directly communicating with humans in a wide range of fields, like science, literature, and much more. In addition, AI is now starting to have faces and voices that are difficult to distinguish from real people, and is starting to use work tools like Microsoft Office to create useful materials. If you cannot change your job to an AI-related field right away, the most effective way to jump on the AI era is becoming an owner, a shareholder of AI companies. However, if you invest in stocks just by reading newspapers without any numerical basis, your portfolio may suffer a great deal. For example, Microsoft is one of the oldest and most notable winners in the IT industry. Nevertheless, if you invested in its stock at its peak in December 1999, it would have taken you almost 16 years, until October 2016, to recover the original purchase price. Even if we don't single out the exact peak, it took about 15 years for the stock to recover its high prices in 1998. Therefore, we should all recognize how dangerous blindly picking blue-chip stocks without considering its price can be. So in today's video, I will introduce ways to take full advantage of the AI era, while avoiding these lost decades in your portfolio. Let's start with 3 ideal conditions for successful growth investing. First, it would be great if we can spot a prominent growth industry early on, with a potential to grow 5 to 10-fold in the next decade. Second, once we find such growth area, we should be able to identify specific companies that will thrive in that field. And lastly, no matter how great the industry and companies are, we should not overpay for the stocks. So it would be great if we can buy these promising companies at a reasonable, or preferably even at cheap price. If we can find opportunities that fit all these categories, it would be very easy to generate high return. The only problem is that it is not so easy to find opportunities that fit all 3 categories. Some people might even say that checking all 3 boxes is just too good to be true. Since the riddle we have to solve for the future is not so simple, let's start with a historical example. From here on, I will analyze how the adoption of smartphone did or did not fit the 3 categories we talked about. The first condition is discovering promising cutting-edge technology in its early stages. For example, smartphones were first released in the mid-2000s, and Steve Jobs' famous presentation for the first iPhone release was held in January 2007. So even if you were not a genius like Steve Jobs, who planned and prepared smartphone years before, even ordinary people like us could directly test the first smartphones and see their potential by 2007. Also, despite such promising future, the penetration rate of smartphones at the time was only 3%. Therefore, even without an exceptional insight, it was possible to predict that the smartphone market overall could grow about 10 to 20 times over the next decade. The important point here is that we did not need very precise predictions like, the smartphone market will grow by exactly how many percentage points this year. Even with some margin of error, it was enough to capture the fact that smartphone is a promising technology that would have a high penetration rate in the long run. And in reality, it didn't even take 10 years for the smartphone penetration to go above 80%, which is about 27-fold increase since the first iPhone launch. There is another aspect we should consider. This graph shows penetration of smartphone in the United States, which is one of the richest and most advanced market in the world. So even if I wasn't very smart and couldn't recognize the potential of smartphones while looking at the iPhone in 2007, it was still possible to gauge the high growth potential of the international smartphone markets after witnessing the explosive demand for smartphones in the US. So again, I am saying that it doesn't require a genius to catch a new paradigm. We just need to pay attention. But even if we figure out the exploding growth of smartphone early on, there is another, more difficult question we have to answer. And that is, who will be the ultimate winners of this growing field in the coming decade? Being able to figure this out is the second condition of successful growth investing. Going back to the smartphone example, let's assume that we have to choose the winners of the smartphone market in the mid-2000s. Natural first choices would be picking the existing dominant players in the mobile phone market, which would have been Samsung, LG, and Nokia. Also, based on Apple's good track record, brand and technology already proved with successful iPods, and seeing how iPhone had some innovative features that consumers liked, Apple could be the fourth choice. In fact, this list of 4 companies would not require any special insight even at the time. Anyone with a basic level of understanding of the market would have picked these 4 companies. However, The problem is that among these top four companies, LG and Nokia eventually became completely obsolete in the smartphone market. Furthermore, Chinese companies like Xiaomi and Huawei became very successful major players in the smartphone market. And this would not have been easy for an ordinary person to predict 15 years ago. So now, let's go back to 2007 and assume that we just had an average level of insight, and so we completely missed out on the rising Chinese stars and just invested in the four easy picks with equal weight. What would have happened? First, Nokia, which was the strongest player in the mobile phone market at the time, suffered tremendous over 70% stock price drop over a period of 16 years. Second, LG also fell behind in the smartphone era, and recently came to close down its smartphone business in most areas. As a result, LG Electronics stock failed to generate even a 5% annual return, and fell far short of the market average for more than a decade. However, because the smartphone wave was so big, even if we had just 50% success rate of picking the winners of the smartphone era, this portfolio yielded a very high annual return of 20%. If we were a bit smarter and had caught the fall of LG and Nokia a little earlier, we could have sold those stocks earlier, rather than holding on to them for 16 years, like we assumed. This would have boosted our return for sure. Also, similarly, if invested in the emerging stars like Xiaomi and Huawei even a few years later, we could have achieved even higher returns. However, what's important here is that, even without such investment skills, we were able to achieve a satisfactory 20% annualized return. Even though this period included the 2008 financial crisis, the COVID crisis, and recent rising interest rates that negatively impacted tech companies. Here, as a counter-argument to the example that I just explained, one could ask, what if I didn't catch up with the new technological change of smartphones early on? So now, let's look at the third condition for successful growth investment, which require us to not overpay for high-quality growth companies. Nevertheless, do these prominent companies ever trade at low prices? Because if they do, it would be absurdly good opportunities, which theoretically shouldn't exist in an efficient market. The good news is that, yes, those great buying opportunities come every now and then. And in most cases, such opportunities are created due to various macroeconomic and stock market-related events. The market gets distracted by external factors, and the stock price of very promising companies drop by around 30 to 50% in a short period of time. And because these opportunities occur once every few years, even the investors who fail to catch the growth tide early on can generate high returns. Let's take a look at 2008 as an example. After the release of the first iPhone in January 2007, the smartphone market entered a full-scale growth trajectory. The popularization of smartphones progressed at an ultra-fast pace, rising nearly 100% in just 1 year in 2008. But during the same period, due to the panic triggered by the subprime mortgage defaults in the financial market, Apple's stock price plummeted by 50%. Moreover, even after the most urgent financial crisis passed, the stock market remained stiff for several years due to the double-dip fear of the global economy. For example, Apple's stock price fell again by 45% in just 6 months in 2012, and the stock traded about 5 times operating earnings in 2013. And that's not the end of the story. In 2015 to 2016 period, when the global economy was recovering and the stock market was booming, I was covering Apple at a research firm on Wall Street. At that time, due to the declining growth rate of the already sizable smartphone market and the sluggish sales of the Apple Watch, Apple's stock price fell by more than 30% in just a few months. And this was when Warren Buffett first started buying Apple stocks, at about 5.7 times operating earnings, and at single-digit free cash flow multiples. In addition, in 2018, when concerns about rising interest rates became more pronounced, Apple's stock dropped again by 33%. So even if we completely missed the investment opportunity at the early adoption of smartphone, the stock market provided several opportunities to trade steadily growing companies at discounted prices. So the two important things to remember here are, first, when the market is distracted, we need to focus solely on the growth of underlying business and tangible cash flow. And second, such investment opportunities do not come every day or month, but once in few years. Therefore, investors need to be mentally prepared in advance and seize the opportunities when they arise, rather than being distracted by macro factors and market fears. In reality, I often see many investors get hung up on macro factors and get very stressed about short-term price movements. However, if you know what you are doing and have a specific target prices in mind, such market distractions should be more like a music to our ears rather than a source of stress. So far, we have checked out how the three conditions for successful growth investing applied to the smartphone industry. Some may say, it's easy to talk about something that has already happened, or the likelihood of another growth investing opportunity, as clear as the smartphone market, is low. The good news is that the current situation of AI industry is quite similar to that of the smartphone industry in 2007. So let's see how the three conditions apply to the current AI investment opportunities. First of all, a new megatrend called AI has just started, and this market has a huge potential. There are still lingering questions like, which AI can be most useful, or exactly how AI will interact or replace human work. But there is no question that AI, which will continue to evolve, will penetrate much deeper into society as a whole over the next 5 to 10 years and longer. Despite this huge growth potential, however, AI is still in its early stage of introduction, so the market penetration rate is very low at the moment. To put it in a numerical context, let's look at the cloud computing, which is an essential element of advanced AI. As Amazon CEO Andy Jassy recently stated, cloud computing only has about 10% of the corporate IT market. Also, even the cloud leaders like Microsoft, Google, and Amazon have just begun to introduce generative AI services on their platforms. So even if we include all the machine learning already being used, the AI portion in the cloud computing is only around 10 to 20%. So if only about 10% of the IT market is in the cloud, and only 10 to 20% of that is using AI, the current penetration rate of AI is only about 1 to 2%. And this indicates the market can grow by dozens of times. Also, even if we can't predict exactly how much AI industry will grow in the coming years, even average people can understand that it's a good timing to ride on this growth tide. This situation overall is very similar to the smartphone market after the release of the iPhone in 2007. What about the second requirement? If we say, identify all the winning companies of the AI era, it may sound too difficult. So let's start with something easy first. For example, cloud computing will directly benefit from the arrival of the AI era. This is because the cloud infrastructure is ideal for AI to function, as it can combine big data for AI training and provide computational power for the AI to function. Related to this, it is well known that OpenAI, the company that created ChatGPT, did not create that large language model with just outstanding ideas. OpenAI's success also required very close collaboration with Microsoft, which provided vast amounts of data and sufficient cloud computing power to train the AI model. Furthermore, the cloud is the optimal channel to deliver AI to various customers. So knowing all this, how can we identify the winners of the cloud industry, which is the second step? The good news here is that the top three cloud companies, Amazon, Microsoft, and Google, dominate the market with about 2/3 of market share. If we add up the market shares of smaller players from the 4th place to the 20th, they only take up 25% of the cloud market. What's even more important is the fact that these top three companies are still taking market share away from these smaller companies. Truly global, well-functioning cloud infrastructure requires tens of billions of dollars of capex and R&D every year, and there are just a handful of companies that can handle this around the world. And because such scale creates economies of scale and operating leverage, the wide moats of these top players continue to widen. In short, it is important to note that, when it comes to AI investments, we don't have to take large risks by investing in small, untested startups that could go under any time. Of course, investors can generate very high return by picking hidden champions, but even without such efforts and risk-taking, we can rely on established companies with long and clear runway for the next decade. Let's look at other areas of AI investing. Semiconductors are the actual brains of AI, and this market can be divided into the memory and non-memory chips. And the memory chip market has long been dominated by the three major players: Samsung Electronics, SK Hynix, and Micron. As the amount of data continues to explode, the fact that there are only 3 companies in the world that can make top-quality chips to store these data is very good news for investors. Regarding the non-memory, GPU chips are known to be the most efficient for AI computations, and GPU designs are also dominated by 3 players. NVIDIA is the clear leader with dominant market share, with AMD and Intel competing against it. So again, it's not so hard for investors to figure out the winners of the GPU market. Not only that, the foundry industry, which actually manufactures these advanced semiconductors, is also compressed into just few dominant players. Taiwan's TSMC is the overwhelming leader, with Samsung Electronics and Intel being the only other companies capable of producing advanced semiconductors on a large scale. However, just like in the smartphone market, there may be new emerging companies rapidly rising somewhere in the AI ecosystem that we cannot predict at the moment. It is very difficult to capture these emerging players early on, and this can be seen as a source of risk. Let's look at this risk from two perspectives. First, the emergence of successful new players is certainly possible. For instance, Chinese social media app TikTok emerged out of nowhere and rapidly expanded based on short-form video and AI recommendation algorithms. But even if a new player rises and we miss it, our portfolio will probably do okay, as long as we include some other winners. As we saw in the smartphone investment example, even though 2 of the existing 4 players completely failed to ride the smartphone tide, and even though Xiaomi and Huawei from China became successful companies in the field, ordinary investors were able to reap a sufficient 20% return for almost 16 years. In short, even if these unexpected new players emerge in the AI field and we completely fail to cope with it, successful investments are still possible as long as we ride the tide. This is because the overall market is just growing so large, and because we avoided overpaying for these companies. Second, there has been a stream of positive changes regarding this new commerce challenge in the AI field, and they arise as a result of the worsening relationship between the US and China. Let's take a step back and see how fast China was catching up with the US in the AI field. As we can see in this research from Stanford University, China was the second country to invest heavily in artificial intelligence. It even caught the US in terms of share of AI paper citations. In addition, Chinese government had long plans to upheaval the semiconductor industry by pouring billions of dollars of subsidies to this industry, which was dominated by the US and Korean companies. Also, on the cloud computing front, the only potential challengers to the top 3 US companies' dominance were Alibaba and Tencent, the Chinese big tech companies. They had low global market share, but by getting to a large scale from its China market, and competing with lower prices in its neighboring regions like Southeast Asia. And again, the increasingly stringent US containment of China is a major obstacle to the ambitions of these Chinese tech giants. Various sanctions against Chinese tech companies, which began with restrictions on the use of Huawei 5G products in the name of national security during the Trump administration, continue to strengthen under the Biden administration. For example, the United States has begun directly limiting the export of advanced semiconductors that are essential for AI research and development to China. As mentioned in Ray Dalio's recent article, Chinese companies are already feeling the direct negative impact of this restriction that impedes cutting-edge AI research. In addition to these direct sanctions, the United States is also increasing indirect pressure. For example, the export of EUV equipment produced by Netherlands ASML is a huge blow to the Chinese semiconductor ambition. That's because EUV equipment is essential for microfabrication, that is essential to produce both advanced memory and non-memory chips. As a result of these various direct and indirect sanctions, China's goals for semiconductor manufacturing, cloud expansion, and advanced AI development are all facing significant obstacles. Whether such restrictions are fair or the most effective restrictions can be argued, but for average investors' perspective, all these changes make AI investing much easier. Because they increase the likelihood of the current AI and semiconductor ecosystem champions, centered around the United States and its allies like South Korea and Japan, to remain winners for foreseeable future with less competitive threat from China. Okay, now let's summarize what we have discussed so far. First, the AI industry's growth, which has the potential to grow 10 to 20 times over the next decade, is now just beginning to materialize. Second, the short list of the major companies that will lead this market is largely revealed already. If this is the case, should we just invest in all the big tech companies right now and just wait? That may not be the worst strategy actually, but we need to check the third condition, which is making sure that we don't overpay. Also, we might be able to decrease risk and increase our return by leveraging market fluctuations due to external factors. This is another very important topic, so I will come back to you in the second video. Please subscribe to this channel and click the like button below if you found this video helpful. Thanks, and see you guys again soon.